Not very much good news coming in from the U.S. either, with the economy there growing just 1.9% in the first quarter of this year against the consensus estimate of 2.2%. Also, weekly jobless claims arose by 10,000 to a seasonally adjusted 383,000, gaining for the fourth straight week. Private sector jobs growth came in at a disappointing 133,000 from April to May, according to a report from ADP and macroeconomic advisors. But to get a better perspective of these numbers and what the outlook for the U.S. economy is, we've got Douglas Blake, who's a wealth manager at Newbridge Securities, joining us on the phone line from New York. Douglas, first up, the 1.9% number against an expectation of 2.2%. How bad is that?
Well, I think a lot of economists had prepared us for this number. Most Wall Street expectations were revised down to that 1.9 from the previously reported 2.2. So this was anticipated. It was in line with our revised downward expectations, but at the same time, it also paints the picture of a decelerating U.S. economic recovery. You know, of course, there are plenty of places to point the finger, but nonetheless, it's disappointing, you know, with all of the different actions, all of the stimulus, that at this stage in the recovery, not only are we at such an anemic rate, 1.9, but we're actually losing momentum.
Right now, Douglas, to the extent that the housing market is beginning to show signs of stabilizing, and also the fact that crude oil prices have come up very strongly over just the last few months, do you expect that in the second quarter GDP growth could look much better? Because there are people who believe that you might see 2.5% growth in Q2.
You know, that's extremely optimistic, and right now I think all eyes are on the Eurozone. This is a market, this is an economy that is, you know, once bitten, twice shy. The financial crisis is still fresh in our minds. You know, the sell in May has worked 3 years in a row now. If you remember the flash crash and the deceleration of the economy last year, very similar themes. So I don't think the mood is right for aggressive growth and expansion in the U.S. We need some resolution out of the Eurozone and its implications for the global economy and the financial system. And we need to see things start picking up here in the U.S. to encourage people to start spending money, to encourage businesses to start hiring. And we need to see the housing market not just bottom, but actually start to recover to encourage banks to go out there and take a little bit more risk.
Right. Also, Douglas, you know, just one quick word on Europe and its impact on the U.S. Now, should we see a situation where Greece is forced to exit the euro? Should we see something on the lines of even a Spexit, as they're calling it now, about Spain exiting the euro? What's the worst-case scenario you're seeing, and what's the impact of that you believe it will have on the U.S. economy?
Well, frankly, the market hates uncertainty, and that's what we're really dealing with now. We don't exactly know what's going to happen if there's an orderly or even a disorderly Greek exit, a Spanish exit, an Italian exit, and we'll have to make up a nickname for that one. But what we do know is that, you know, these phenomena are happening as a result of structural failures in the way that the European Union is built. Different speeds of different economies, different revenues, you know, in terms of taxes, different entitlements. So it's very hard to bring all these things together in a cohesive unit without some sort of fiscal pact, some sort of civil pact, and we just don't see that sort of cohesion right now. But an exit from the Eurozone, while it would have near-term shocks to the global economy, certainly to the financial system, could be the answer that the global economy is looking for longer term. You know, let these countries move at their own speed. Their dramatically weakened currencies may actually promote more business, more tourism, the things that have really bolstered Southern Europe for decades. And perhaps they could get back on their own feet, you know, at their own pace, not at sort of Germans' behest. And that's the kind of thing longer term that could lead to some sort of global economic expansion. But right now we're in the middle of this, you know, this free fall, quite frankly. Italian bond yields, Spanish bond yields unsustainable at these levels. Greek exiting essentially a foregone conclusion at this point. You have to wait for those elections in a few weeks. But, you know, there's so much up in the air right now. It's very hard to say what's going to happen, you know, 2-3 weeks from now, even 20 minutes from now, to be quite honest.